Hi, let's cover my Elliott Wave analysis on Bitcoin on the daily time frame and the 15-minute time frame. Starting on the daily time frame with the bullish scenario where we're looking for 5 waves to the upside, and after wave 5 we want to see a retracement. Wave 3 is put on the current top here at 126k, which also is in line with the 1.618 trend-based fib extension taken from the start to the end of 1 to the end of 2, which is a common target for a wave 3. Now, after a wave 3, you like to see wave 4, and this could be the beginning of a wave 4, which likely is a sideways corrective structure in a flat ABC, a more sideways WXY, or for example a triangle. We'll have to wait and give price a little bit of time. Preferably, this wave 4 is going to take about a week, maybe longer, but commonly wave 4 is quite similar in time compared to wave 2. Wave 2 was about a week, so preferably wave 4 takes about a week as well. Again, potentially a little bit longer. Target area for wave 4 is between 122.1k and the invalidation of this scenario, which sits at 118k, as wave 4 and wave 1 are not allowed to overlap. Now, there is maybe the potential, if price climbs to the upside and makes another high, that your wave 3 is going to move to the new higher high here. But in general, it doesn't change the probabilities of the past couple of videos on the daily and the 4-hour time frame that we are looking for a larger range to form or a larger retracement. So we're literally moving towards the end of an impulse here to the upside, which potentially already ended, mainly due to the volume and the candle size as discussed in previous content, where the largest candle to the upside is in the middle. You can see the candles are slowly getting smaller and smaller, while you can also see the curvature. Here price is curving to the upside, most vertical bit, and then you can see price curving horizontal again, plus you see volume moving down. This is a very, very typical impulsive structure to the upside, bunch of 1-2s, then you get your vertical wave 3, you get a bunch of wave 4s and 5s, and eventually after your 4s and 5s, you look for a retracement to the downside, which in this scenario would then lead to a larger sideways range. So a retracement to the downside is absolutely expected. Now then we have the more bearish scenario, but bottom line, actually this is still bullish, because here you just look for a larger corrective structure, a bigger 3-wave move, and upside at a later stage. And in this case, you want a wave C to the downside, which should be a motive wave. So an impulse is most common, a diagonal is less common. So preferably you're going to see a wave 1, 2, 3, 4, and 5 wave structure, and after C is finished, you look for price to move towards the upside. Now in this scenario, the subwave count of B, A, B, C, the subwave count of B is then counted as a zigzag in a wave A, wave B, and you look for wave C. In this scenario, after wave C, we then want to see motive waves down. Now this wave C at the moment is reaching the 1.618 trend-based fib extension of wave A, which is still very much a target for a wave C. But if price is going to move beyond the 1.618 and starts closing candles all the way up here and getting close to like 128 and 138, it will reduce, or sorry, 131, it will reduce the probabilities for this scenario, even though price is still inside the target area for a wave B of a larger flat structure, A, B, C. The subwave count of wave B, which is a simple zigzag ABC, starts to make less sense as your wave C moves beyond the 1.618. So the 1.618, fine target for a C, no problem. Moving beyond it starts to lower the probabilities for a zigzag ABC to the upside, increases impulsive probabilities. But because the probabilities for an ABC zigzag decline, it automatically declines the probabilities for a wave B, and therefore probabilities decline for this scenario compared to an impulse to the upside. And then we get to the 15-minute time frame, and I assume many people are interested in this time frame because of the action that we had yesterday and because of the video that I posted yesterday as well. So as per the content yesterday, I mentioned if price can move above this high here at 124.7k, the probabilities are highest that this structure to the downside is a corrective move, not a motive move, which increases the probability probabilities to sooner or later take out the all-time high. And in that video, I was also drawing therefore the potential for larger corrective structure, because this can be the beginning of a larger corrective move. I realized I was drawing a sideways structure, but a WXY double zigzag being a sharp structure is also a possibility, something I at least keep an eye on here with the price action that we have. Now, something that I'm going to explain now I think is very important for every Elliott Wave analyst and viewer, in case you're not an analyst yourself. Elliott Waves is a game of probabilities. It's high probabilities and low probabilities, but as an analyst, it's your job to know the higher probability and the lower probability. The moment price takes out this high, there is no way the highest probability scenario here is a motive wave, impulse, multi-on-two, or a diagonal. If so, it's wrong analysis and wrong probabilities. If you align yourself with Elliott Wave Theory, according to the book, according to all the knowledge, as per Elliott Wave International, Elliott Wave Principle, and just Elliott Wave Theory in general, there is no highest probability motive wave to the downside here. The probabilities will always be highest for this structure to be a corrective move to the downside. And I'll explain this by showing you a couple of photos. When price was moving to the downside here, we took out this low. I was riding in the Elite group, which is the membership that I have, doing short-term updates. And it is important to always be neutral, because the market doesn't care about your feelings and what you're looking for and this and that. It's about having bearish and bullish scenarios and be able to distinguish the probabilities. Are they higher for this or higher for this? So the moment price started moving down, I was like, okay, let's have a look at potentially bearish scenarios and consider them, but also explain why the probabilities, also as per highlighted yesterday, are lower for motive waves to the downside, but now in a little bit more detail, which many of you actually like. So one of the options, I have three photos here. One of the options is a multi-1-2, where over here you have a wave 1, wave 2, highest degree, another 1-2, lower degree, and then price moves down. In this scenario, your lower degree wave 1 has to be some sort of an expanding diagonal structure. An expanding diagonal is very rare, never preferred, unless everything else fails. So this can never have the highest probabilities. Another option to maybe get a motive wave to the downside here is starting with a diagonal 1, 2, 3, 4, 5 that does not finish at the low, because you cannot finish a diagonal at the low, as wave 5 is longer than 3, which is not allowed in a contracting diagonal. And if you want to consider an expanding diagonal from all-time high to this low here, you can't, because wave 4 is shorter in price than wave 2, which is again not allowed. So diagonals that finish at the low are not possible according to the rules and the guidelines. But if we then consider a diagonal that would finish over here, the higher low, and then this low is a B, and then a diagonal wave 1 or wave A, you get a move up in A, the low is B, and this has to be some sort of a wave C to the upside, which has to be a 5-wave structure. So you need a wave 1, 2, this had to be like a 3, I don't know what the wave 4 here, right, has to be. And then this leg up has to be your wave 5 to the upside, basically. It looks arguably a bit better as a 3-wave structure to the upside. But anyway, it's not really about this leg up. It's about counting a diagonal followed by A, B, C. In this scenario, your wave B moved way beyond the 1.618 Fibonacci taken from the start to the end of wave A. And the fact that it did significantly reduces probabilities for wave Bs. Your most common target for wave Bs in an expanding flat is the 1.236 to the 1.38 Fibonacci. Minimum target for a flat is the 0.9. Generally, the 1.618, currently sitting here at 123.8K, generally the 1.618 is seen as like a soft invalidation, because in the end a wave B of a flat doesn't necessarily have a hardcore hard invalidation, but the 1.618 is seen as a soft invalidation. You hit the 1.618, you're not actually looking at a flat anymore, at a wave B or a wave X. The fact price not only touched the 1.618 but continued to the downside and even wicked below a 2 Fibonacci taken from the start to the end of wave A, it just really significantly reduces the probabilities that this low over here is part of a wave B or a wave B or a wave X of a larger corrective structure after this diagonal. And just for a little bit of extra theory and detail, generally after a diagonal, you expect a deep retracement and by far most commonly a zigzag family structure, not a flat. So preferably after a wave 1 diagonal, leading diagonal, which by itself is already quite rare of course, but after a leading diagonal you actually like to see a wave A, a wave B, and a wave C that comes close to the all-time high, or at least reaches like a golden pocket or a 0.7, maybe even an 886, and then go down. So a zigzag family structure up, ABC or WXY double zigzag, deep retracement, and then go down. You don't like to see flats after a diagonal. It's not impossible because it's just a wave 2 or B, and it's absolutely valid to have flats, but then you get into the trouble with your wave B here. Finally, if we consider a double 1, 2 like this, we have the same problem with the wave B, because here we have again 1, 2, this, whatever this is, has to be some sort of a wave 1 diagonal. Then you get another ABC, that's your 2, and then down. Your wave ABC is the same. Your wave B, therefore, once again, move below the 1.618. There is, and I'll repeat, there is no highest probability motive wave to the downside here. If this turns into a motive wave, it is going to be hindsight counting based on the new information that we then receive as price is printing candles. But you can imagine the moment price moves above this high, there is zero reason to put the highest probabilities of this move down on top of a motive wave. You're going to be like, well, higher probabilities corrective. Higher probabilities, there is some corrective structure in this move to the downside. Yes, we can get a double 1, 2 in here. We can get a diagonal in here, but by no means is that period going to be a highest probability scenario. But then now, we have to remember Elliott waves is probabilities, high and low probabilities, which means low probabilities still have some probabilities. It's by far not the highest probability, but it can happen that you get a move to the downside, which is as ugly as this is, and in the end, it's going to be counted as a wave 1 or a wave A, which means it is motive. But that is then going to be something that we look at after the fact. So then we have, for example, when we look at the different scenarios, we got to keep in mind the potential of a WXY, where this is a zigzag to the downside. We then get a zigzag family structure in wave X, and then a zigzag structure in wave Y, which can still create another low in an A, B, C to finish Y and then move up. Wave Y, the target is between the 1 and the 1.236 and the 1.618. This is very common. The 1.618 is still a target for a wave Y. Wave Y possibly can be finished at the low. Maybe you're going to create a larger structure. Doesn't really matter too much. Bottom line, a WXY to the downside would be that larger corrective structure I was talking about yesterday, where this is still labeled as a corrective move, where this last leg down here is labeled as a wave C. So you're basically looking for like an A, B, C. And maybe your wave A here, right? Your wave A is being that diagonal. Okay, possible. Then you get this wave B, little nudge to the upside here, which can be internally a flat. And then you get an impulse down in a wave C. Possible. But now we're looking at a corrective structure down, not a motive wave down. That's a big difference. So yes, we have a diagonal in here, but this last down is now labeled, last leg down is labeled as a C, not a B. It's not part of a corrective structure that is like A, B, and then C to the upside. So here we then have an A, B, C, and a W. Corrective structure X, maybe Y finished here, maybe you get another low. It doesn't matter for the general context. After a WXY, you aim for price to eventually move up and retrace the move to the downside to the 0.9 Fibonacci minimum. So you take a fib from the start to the current low, if that's the low of wave Y, and you toggle on the 0.9. That is a minimum target after a WXY. Currently at 125.7. If this turns into a zigzag over here and price comes back down for potential Y, you will take it to the next low. And that is because a WXY can only be a sub-degree count of a bigger flat, and then a wave A, wave B, wave C, and the minimum target for a flat is the 0.9 Fibonacci. Then we get to the scenarios where we have to count this move to the downside as an impulsive, or at least a motive wave structure. So either a diagonal, or an impulse, or a multi-1-2, one of all those. So here we then have some wave 1 to the downside, you get your wave 2 over here, and then 3, 4, 5. Wave 4, not allowed to touch the 0.618 at 123.6K. That is an invalidation for 4. I do not use this low as an invalidation for wave 4. Reason being that if this low here is somehow a wave B or whatever of a larger corrective structure, right? Wave 4, in theory, and price action of wave 2 are allowed to overlap. It is only a strong guideline that you don't want to see the overlap between 2 and 4, but in theory, it is allowed to have that overlap between a 2 and a 4. So therefore, instead of using this low over here as an invalidation, because is wave 1 going to be there? Is wave 1 going to be there? Right? Who knows? Instead of using that low, I prefer to just use the general guide, like supposed guideline, the one that we use here. Price touching the 618, 123.6, significantly reduces wave 4 probabilities, increases probabilities this move down is an ABC or a WXY corrective structure. Your bearish alternative is going to be a wave 1, 2, 1, 2, and then you look for a large wave 3 to the downside. Big move, and then eventually you want to see a 4, 5, 4, 5, and after your wave 4s and 5s, you look for price to turn around. This could be your wave C of the larger flat to, say, the low like 107, 109, like 105, that sort of stuff. However, a multi-1-2 to the downside doesn't have the highest probabilities for a couple of reasons. One reason, your lower degree wave 1, let me quickly remove this here. If you want to count this as a 1, 2, 1, 2 down, your lower degree wave 1 here is longer than your higher degree wave 1, which reduces the probabilities. By no means an invalidation, it can happen. However, you also see that this range here is larger than this one. So if we want to count this as a highest degree 2 and this is a lower degree wave 2, your lower degree wave 2 is now quite a bit longer in time compared to your higher degree wave 2, which is also not preferred. If we only take this little move to the upside compared to the range is now over 3 times longer. And if we would consider maybe some sort of a flat structure here, right, in here, pop, then you can see that now this range is longer. It's not yet twice the length, but it is longer in time as well. Preferably lower degrees, wave 1 and 2s are similar or shorter in price/time compared to the higher degree, wave 1 and 2. So maybe if you pull a flat off here, you can still allow this, but it starts to get very long. And lastly, preferably in a multi-1-2, you see overlaps between the wave 1s and 2s. So what's ideal is that you get 1, 2, 1, 2, 1, 2, and then you fall, mimicking a diagonal scenario, which is very common for multi-1-2 structures. And I always use this example because it's just a perfect example of a multi-1-2 over here. Looks like a diagonal. Diagonal always lower probabilities than a multi-1-2, and then you get the 3 towards the upside. So those are the reasons why I'm not really looking at a multi-1-2 over here. Of course, price can move down, but if it does move further down, I'm either looking for a wave 5 to end an impulse 1, 2, 3, 4, 5, as long as you don't touch the 618, and then look for price to create a bounce and move to the upside. Keep an eye on areas of support. Alternatively is going to be this here, where the move to the downside is counted as ABC. Wave A means this has to be a motive wave, whatever stuff to the downside. And then your ABC is the first structure of a larger corrective move, where this is going to be a W or a wave A. And then you're looking for an X and a Y, or you're looking for a B and then a wave C, and maybe even a triangle, where then you have a wave D and eventually a wave E, right? So an ABC to the downside opens the door to many different scenarios, which can include a double zigzag, by the way, in a WXY, ABC, correction, ABC. But this is a big difference with a 5-wave impulse to the downside, even if you don't touch the 618 for your wave X. The big difference here is that wave Y is going to be a 5, 3, 5. If we are looking at an impulse to the downside, you want a 5, go back up. You don't look for a 5, 3, 5. That's wave Y. So a single 5 down, and then price moves up, 1, 2, 3, 4, 5 impulse. If you get a 3-wave, 5, 3, 5, which we will be able to recognize by looking at the bounce, because this bounce over here, right, should be a bigger structure compared to this one, and eventually take out the high. And based on the autonomy autonomy of the bounce will be able to recognize this, but this is just a big difference. 5-1-5 wave move to the downside. Wave Y is a 5-3-5 to the downside. So that's the big difference. But yeah, an ABC here to the downside, cool. Like ABC can merge into larger structures, but based on the price action, we have to be patient and see what we get, because this would just be the beginning. And an ABC, again on the daily, if we're looking for a wave 4, an ABC can lead to the larger structure that we want an ABC in a wave 4, being like a flat in an ABC, a triangle ABCDE, a WXY, right? Those type of structures. Mind you that a WXY to the downside can also be part of the flat ABC, and the flat can be your first structure of a larger WX and a Y, but we'll have to figure that out at a later stage. No? So that's a lot of talking about the 50-minute time frame, but I can imagine after yesterday especially, there's a couple of questions, and I just want to kind of like drill home that, you know, Elliott Wave's bottom line is about probabilities. It doesn't mean that your analysis is wrong when you are like, well, the probabilities are highest for that to be corrective and price moves down. By no means does it mean your analysis is wrong. Sometimes a lower probability scenario quite simply plays out, but you're still good in your analysis. And besides all means, there's very much still the possibility of a WXY here, where this is still going to be counted as a corrective structure internally, ABC, which drills home the point that probabilities would still be higher, that this over here would be an ABC. But anyway, let's go to the next part. So a couple of levels here for you guys. So here you go, support and resistance levels on my chart. Then we have the time frame horizontals, ta-da, and we have the order blocks, and absolutely perfect over here. Price moving down into the 12-hour order block. Let me show this again. So here you go, 12-hour order block. Perfect touch. Very, very nice. And what is also very, very nice is that price here came down, right? Comes back down, it just comes down, and then it starts overlapping here, right? We start to move a little bit more sideways here, right? Sideways, overlapping structure. Volume decreasing, and it's the same thing on the daily time frame, but the other way around. On the daily and 4-hour time frame, the move up from 108, right over here, if I zoom out, we were looking or are looking, or you know, we have the 1-2s, the 3s, and then the 4-5s, and the 4-5s preferably a couple of highs on a decreasing amount of volume. Then you look for price to turn around. You look for price to create either a larger range in 4, or potentially you get your wave C to the downside, but you are looking for a retracement or a larger range. And this is similar, but then on a lower time frame. You get a sharp move to the downside, price eventually starts overlapping, and you know, it's slowing down, volume is going down as well as you are moving in an area of support. And I think in a previous video, I'm not sure if it's the previous video or the one before, but I was talking about keeping an eye on this. And especially if you slow down, declining volume, overlapping price action on top of an area of support like Chef's Kiss, like that is such a nice opportunity as well. And then the initial bounce by itself can already be a 1-2 good RR opportunity, even without the current move here that we have towards the upside. So very, very nice, very, very nice. Then we get to the news. Let me actually go to the news, because we do have news today here. As you can see, 8 p.m. Central European Time, Friday as well, 4 p.m. Central European Time. Trade safe, volatility can increase. Then we get to probabilities and a bit of a conclusion, I suppose, as well. So on a weekly time frame, by the way, nothing changed as per previous content. Didn't cover the weekly here. On a daily time frame, we were expecting a retracement. You can go back to the previous videos, and you know, we were looking for 4s, 5s, and eventually a retracement is expected. So looking for a retracement, a larger range in a wave 4 preferably takes about a week. If price would move to the upside over here, right, you get an impulse up and you move up, maybe that wave 3 is going to move higher, but it doesn't change the fact that as we are looking for wave 4s and 5s, we are expecting a larger range or a larger retracement. The range in the wave 4 should take about a week. If you get a wave C to the downside, I mean, probably that wave C is also going to take something like a week. So at some point, you just expect some either sideways or sharp price action. Now, the retracement was then expected, of course, cool, but we wait to see what structure is forming. And that's the phase where we are in now, because at the moment we have a 3-wave to the downside here, and we have to be a little bit patient to see what is happening. But what I can give you is a couple of, I suppose, guidelines that influence the probabilities of scenarios. So locally, if price moves up to 123.6K, which is the 0.618, this one here, then the probabilities are higher. The move down from the all-time high is a corrective structure, WXY or ABC. If so, then we are looking for price to take out the all-time high at a later stage. And that can be sooner, that can be later. We don't care, the bias is set. If price takes out the local low, this one over here, there is the potential for an impulse down 5 waves, 1, 2, 3, 4, 5, as long as wave 4 is not reaching the 0.618. And if it does reach the 0.618, and then price goes down, we have to consider corrective structures, WXY double zigzag, or we get here a flat ABC, where this is then your X, and then you get Y, and you look at a more sideways structure, right? Those are things to then consider, okay? But we need to wait for a bit more information. So potential for a 5-wave down, possibly a WXY double zigzag that was previously unfinished as well. Right, WX and the Y, take out the low, reach the volume level that we have. If that holds, the price moves up. Interesting, no? Okay, and if we get the move back up, so if price takes out this low, and we have the potential 1, 2, 3, 4, 5, or a double zigzag, the move to the upside is quite simply going to be important, because if the move to the downside here is a motive, 1, 2, 3, 4, 5 wave structure, we want a corrective move to the upside to then get another 5 wave down. So important, if we look for a WXY to the downside, we want to see motive waves to the upside. So preferably impulses, 1, 2, 3, 4, 5, correction, 1, 2, 3, 4, 5, and continuation, multi 1, 2, impulse to the upside. But that's the big difference. Impulse, bearish, 5 down, 3 up. Bullish, 3 down, 5 up. In both cases, you're looking for a bounce. After a wave 5, you look for support and price moves back up, preferably correctively 3-wave structure. And if you're looking at a corrective move to the downside, but you still take out the low and maybe a WXY, after a wave Y, you want to see a motive wave towards the upside. So that's the big difference. Instead of a 3, you want to see a 5. Be aware that an ABC to the downside here, ABC, can merge into larger corrective structures like a flat, a WXY, or a triangle. It really depends on the price section. We just got to be patient. That being said, I hope this video was helpful or valuable to you. On the left, you can see a video on the simplest way to use and trade Elliott Waves without even counting. And on the right is the Elliott Wave educational playlist to help you understand more about Elliott Waves. Thanks for watching and subscribing, and I hope to see you at the next one. Bye-bye.